In 1926, Henry Ford did something that confused almost every other industrialist in America. He cut his factory workers' hours from 48 per week to 40. 5 8-hour days instead of 6. And he didn't do it because a union forced him to. And he didn't do it because he'd suddenly discovered compassion for the working man. He did it because he ran the numbers, and the numbers told him something that most employers in 2026 still haven't fully absorbed. Workers who had 2 days off instead of 1 had time to do something employers desperately needed them to do: spend money. Ford needed a population with enough leisure time to drive his cars, to take their families places, to develop the habit of consumption that an industrial economy depends on. The 40-hour week wasn't designed as a gift to workers. It was designed as an input to a production and consumption system, calibrated to produce exactly enough free time for a worker to recover, spend, and return Monday ready to produce again. A century later, that exact structure still governs the majority of working adults in developed economies. And in this video, we're going to look honestly at what that structure actually does to your ability to build wealth, not as a conspiracy theory, but as a straightforward analysis of incentives, math, and the structural ceiling that trading time for money places on everyone operating inside it. This is not a video telling you to quit your job tomorrow. It's a video explaining exactly what the 40-hour model was built to do, what it does extremely well, and what it was never designed to do, which is make you wealthy. My name is Daniel. Let's look at the actual mechanics. The origins nobody teaches you. The 40-hour work week as a near-universal standard didn't emerge organically from market forces discovering the optimal human schedule. It was constructed deliberately, over decades, by a specific combination of labor organizing, government regulation, and, critically, employer self-interest that gets left out of most retellings. The Fair Labor Standards Act of 1938 codified the 40-hour week into U.S. South federal law, mandating overtime pay for hours worked beyond it. This is frequently taught as a pure labor victory, and in important respects, it was. Workers in the early 20th century routinely worked 60, 70, even 80-hour weeks in dangerous conditions for wages that left no margin for anything beyond survival. The reduction in hours represented genuine, hard-won progress against exploitative conditions. But the full picture includes something rarely discussed in that framing. Industrialists supported shorter hours for their own reasons, separate from worker welfare. Henry Ford's 1926 decision is the clearest documented example. In a 1926 interview, Ford explicitly stated that the prosperity of the country was dependent on the proper distribution of buying power, and that a worker with no leisure time becomes a poor customer, having no time to use any necessities or comforts besides the bare necessities of life. He understood, correctly, that an economy built on mass production required mass consumption to absorb that production, and mass consumption required workers with both the income and the time to spend it. This is not a criticism of Ford, or a claim that shorter work weeks were bad for workers. They were a genuine improvement in quality of life, and were won partly through labor struggle. But understanding the full set of incentives behind the standard, including the employer interest in a population calibrated for predictable production and predictable consumption, explains something important about why the structure has remained remarkably stable for nearly a century, while almost everything else about the economy has transformed. The 40-hour week was optimized for an industrial economy that needed reliable workers and reliable consumers. It was never optimized to maximize individual wealth accumulation. Those are different goals, and the structure reflects the goal it was actually built for. The mathematical ceiling nobody states plainly. Here is the constraint that the 40-hour structure places on anyone operating entirely within it, stated as simply as possible. There are 168 hours in a week. A standard full-time job consumes 40 of them directly, plus commuting time, averaging 27.6 minutes each way according to Census Bureau data, or approximately 4.6 hours per week, plus the recovery time most jobs require, getting ready, decompressing, the cognitive load of a demanding role that doesn't simply switch off at 5 p.m. Realistically, a full-time job consumes somewhere between 50 and 55 hours of a worker's week when you account for the full footprint, not just the scheduled hours. This leaves roughly 113 to 118 hours for everything else: sleep, family, health, household maintenance, and any additional income-generating activity a person might pursue. Here is the part that matters for wealth building specifically. Income from employment has a hard ceiling, determined by hours available multiplied by rate of pay. If you are paid $35 per hour and work 40 hours, your weekly income ceiling from that activity is $1,400. Full stop. You cannot work 60 hours in a 40-hour structured rule without entering overtime territory that most salaried positions don't even offer. And even their overtime exists, there are legal and physical limits on how many additional hours a person can sustainably work. This means that for the majority of people operating purely within W-2 employment, income growth is gated almost entirely by rate increases, raises, promotions, job changes, rather than by hours worked. And we know from labor data exactly how slowly that gate opens. The median annual raise for workers who remain at the same employer has hovered around 3 to 4% for the past decade, barely outpacing inflation in most years, and falling behind it in years like 2021 through 2023. Meaningful income growth through employment alone requires either promotions, which are limited and competitive by design, or job changes, which carry their own friction and risk. The structural reality is this: a system built around trading a fixed block of hours for a fixed rate of pay has a ceiling on how fast wealth can be built through that channel alone, regardless of how hard or how skillfully someone works within it. Why this ceiling exists? By design, not accident. It's worth being precise about what designed to prevent wealth actually means here, because it's easy to slide into either dismissing this as conspiracy thinking or overcorrecting into believing it's a deliberate plot against workers. Neither framing is accurate. The more precise claim is this: the 40-hour employment structure was designed to optimize for organizational predictability and consumer economy stability, and wealth accumulation for the individual worker was never the variable being optimized for. It's not that anyone sat in a room intending to cap your net worth. It's that the entire system of incentives, from how compensation is structured to how careers are designed to progress, rewards behaviors that produce reliable labor and reliable spending, not behaviors that produce capital accumulation. Consider how compensation packages are actually structured in most full-time roles. A salary, paid biweekly or monthly, calibrated to cover a worker's living expenses with some margin, but rarely so much margin that the worker accumulates capital quickly enough to develop real independence from continued employment. Employer-sponsored benefits, health insurance, retirement matching, vacation accrual, that increase in value the longer an employee stays, creating what labor economists call golden handcuffs. On the left 560's Discovery, all these Kayleen bombs, which discover most of their books, the one great Kayleen bombs, and which discourage job changes even when a worker's market value has increased. None of this requires malicious intent from any individual HR department or hiring manager. It's the emergent result of a system where employers, individually and collectively, benefit from a workforce that shows up reliably, doesn't have so much financial independence that quitting becomes trivial, and has just enough disposable income and leisure time to participate as consumers in the broader economy. This is precisely the dynamic Ford identified explicitly in 1926, and it has not fundamentally changed in the century since. The structure rewards consistent labor and consistent consumption. It does not particularly reward, and in several specific ways actively discourages the kind of capital accumulation that produces genuine wealth independence. The specific mechanisms that work against wealth building. Let's get concrete about the specific structural features of standard employment that create friction against wealth accumulation. Not vague cultural critique, but identifiable mechanisms with measurable effects. Taxation structure on earned income versus capital. W-2 wage income is taxed at ordinary income rates, which in the United States range up to 37% federally, plus state income tax in most states, plus payroll taxes for Social Security and Medicare, totaling 7.65% paid directly by the employee, with an equal amount paid by the employer. Long-term capital gains, profit from investments held longer than a year, are taxed at a maximum federal rate of 20%, with many investors qualifying for 15% or even 0%, depending on income level. There is no payroll tax on capital gains. The practical effect: a dollar earned through employment is taxed meaningfully more heavily than a dollar earned through capital appreciation. This is not an accident of tax policy. It reflects a tax code that has historically been shaped with substantial input from people who hold significant capital. And it means the tax structure itself favors wealth that's already accumulated over wealth that's being earned through labor. A worker earning $75,000 annually faces a marginal federal tax rate of 22%, plus FICA, plus state tax, an effective burden that frequently exceeds 30% of marginal income. An investor with $75,000 in long-term capital gains, depending on their overall income, may pay 15% or significantly less. The system is structured so that money makes money more efficiently, tax-wise, than people make money through labor. The time for money trade has no scalability. This is the single most important structural limitation, and it's almost definitional rather than incidental. When you sell your time for a wage, your income is mathematically bound by the hours you have available. There is no version of standard employment where your income scales independently of your time input. Your raise might increase the rate, but the hours times rate ceiling remains structurally fixed. Compare this to capital, business ownership, or intellectual property. Income sources that can generate returns without a linear relationship to the owner's personal hours. A dividend-paying stock portfolio generates income, whether the owner is awake, asleep, on vacation, or focused entirely on something else. A rental property generates income through tenant payments, regardless of the owner's daily hours worked. The 40-hour employment structure by design ties income directly and permanently to hours, which means it has a hard ceiling that capital-based income simply does not have. Limited time for skill development outside the employer's interest. The 50-plus hour weekly footprint of full-time employment, including commute and recovery time, leaves limited bandwidth for developing skills, building businesses, or managing investments outside of work hours. This isn't a moral failing of workers who don't make time. It's an arithmetic reality of finite hours and the genuine cognitive and physical demands most jobs place on the people doing them. The result is that the skills workers do develop are disproportionately the skills their current employer needs, which increases their value to that specific employer, but doesn't necessarily build the kind of broadly transferable capital, financial, literacy, business skills, investment knowledge that produces independent wealth. Healthcare and benefits tied to continued employment. In the United States specifically, employer-sponsored health insurance covers approximately 54% of the non-elderly population, according to KFF data. This creates a structural disincentive to leave employment, start an independent venture, or take entrepreneurial risks, because doing so frequently means losing healthcare coverage at a moment when income is least certain. This linkage between employment and essential services is not present in most other developed economies, and it specifically increases the switching costs and risk calculus of stepping outside the standard employment structure in the U.S. South context. What the data shows about who actually builds wealth. Here is where the structural analysis meets the empirical reality of how wealth is actually distributed and accumulated. According to Federal Reserve Survey of Consumer Finance's data, the primary residence and retirement accounts, the two wealth-building vehicles most accessible within standard employment, represent the majority of net worth for middle-income households. But the composition of wealth changes dramatically as you move up the wealth distribution. For households in the top 1% by net worth, a much larger proportion of total wealth comes from business equity and direct investment holdings outside of retirement accounts, capital that is actively deployed, not capital that accumulates passively through payroll deduction alone. Federal Reserve data consistently shows business ownership as one of the strongest single predictors of high net worth, far outweighing income level alone. This pattern holds across decades of data. High income from employment correlates with comfortable living standards and steady retirement account growth. It does not, on its own, correlate strongly with the kind of wealth that produces genuine independence, the kind where work becomes optional rather than necessary. A physician earning $300,000 annually and a small business owner earning $150,000 annually frequently end up in dramatically different wealth positions after 20 years, not because the physician is financially irresponsible, but because the physician's income, however high, remains capped by the hours times rate ceiling we described earlier, while the business owner has access to equity appreciation, the ability to scale income independent of personal hours, and more favorable tax treatment on business income and eventual sale proceeds. This is not an argument that everyone should quit their job and start a business. Most businesses fail, and the risk profile of entrepreneurship is genuinely not appropriate for every situation or every season of life. It's an observation, supported by the data, that the wealth-building ceiling inherent in pure employment income is real and measurable, and that the households who break through it overwhelmingly do so by adding income sources that don't share the same structural limitations. The specific numbers on time and compounding. Let's make the cost of the time for money ceiling concrete with actual figures, because abstract structural critique is less useful than seeing what it costs in dollars. Consider two people earning identical W-2 incomes of $70,000 annually, starting at age 28. Person A relies entirely on employment income, contributes 8% to a 401k with a 4% employer match, a common structure, and otherwise spends according to their lifestyle. Over a 35-year career, assuming 3.5% average annual raises and 7% average investment returns, Person A retires at 63 with approximately $890,000 in retirement savings. A solid, respectable outcome, well above the median American retirement balance. Person B starts with the same job and income, but in year 3 begins dedicating 8 to 10 hours per week, roughly the time most Americans report spending on entertainment media, to building a secondary income stream. Freelance consulting in their professional field, initially generating modest amounts, but growing as a client base develops. By year 8, this secondary income reaches $15,000 annually. By year 15, it is scaled to $40,000 annually with reduced personal time investment as systems and referral relationships mature. Person B invests 100% of this secondary income, on top of maintaining the same 401k contribution rate as Person A. By age 63, Person B's retirement and investment accounts total approximately $2.1 million, more than double Person A's outcome. Not because Person B worked dramatically more total hours across the full 35 years, but because a portion of Person B's income was structured outside the hours times rate ceiling, capable of scaling through means other than additional personal hours, and benefiting from more favorable tax treatment as it grew. The difference is not effort. Both people worked hard within the standard employment structure. The difference is that one income stream was structurally capped and one wasn't. What this doesn't mean. It's worth being explicit about what this analysis is not arguing, because it's easy to overcorrect into unhelpful conclusions. This is not an argument that having a job is a mistake, or that everyone should become an entrepreneur, or that the 40-hour work week is uniquely evil in a way that distinguishes it from any other compensation structure in economic history. Every economic system has structural features that shape behavior in ways that don't necessarily serve every individual's optimal outcome. That's simply what it means for a system to have structure at all. The 40-hour week, for all its limitations as a wealth-building vehicle, also provided genuine and significant benefits. Protection from the 80-hour exploitative work weeks of the early industrial era. Predictable income that allows for planning and stability. And, for many people, a genuinely sustainable way to balance work with the rest of a meaningful life. The honest conclusion is narrower and more useful than the system is rigged, abandon it. It's this. Standard employment income has a real, measurable, structurally embedded ceiling on wealth accumulation, caused by the inherent limits of trading fixed hours for fixed compensation, compounded by tax treatment that favors capital over labor. Understanding that ceiling clearly, rather than assuming that working harder within the existing structure will eventually produce wealth independence on its own, is what allows people to make informed decisions about whether and how to build income streams that don't share the same structural limits. What you actually do with this information. If the ceiling is real, what's the practical response? Here are the specific evidence-based paths that data shows actually move people past the structural limitations of pure employment income, not as guaranteed outcomes, but as the mechanisms that have consistently worked for people who have broken through. Maximize what the employment structure does offer, fully. Before looking outside the system, make sure you're capturing everything available within it. The full employer 401k match. Turning down free money doesn't make sense regardless of broader structural critique. Tax-advantaged accounts, used to their legal maximum, partially offset the unfavorable tax treatment of W-2 income. Salary negotiation and strategic job changes, since data consistently shows job switchers out-earn those who stay, partially compensating for the slow internal raise structure. Build a second income stream specifically designed to scale independent of your hours. This is the single highest leverage move based on the data we just walked through. It doesn't need to start large. It needs to be structured so that, over time, the relationship between your personal hours and your income from that source weakens through systems, automation, content that compounds, client relationships that generate referrals, or products that sell without your direct involvement in each transaction. Convert earned income into capital as aggressively as your situation allows. Every dollar of W-2 income that gets converted into invested capital, index funds, real estate, business equity, begins operating under the more favorable tax treatment and uncapped scaling potential that capital enjoys and labor doesn't. The faster this conversion happens and the earlier in your working life it begins, the more time that capital has to compound under rules that are structurally more favorable than the ones governing your paycheck. Treat the ceiling as information, not as an indictment. The 40-hour structure isn't going anywhere, and for many people, in many seasons of life, it remains the right and most stable choice. The value of understanding its structural limitations isn't to feel resentful about them, it's to make clear-eyed decisions about where your effort outside of required working hours goes, rather than assuming that simply working harder within an inherently capped structure will eventually produce the wealth outcome you're after. The conclusion. The data actually supports the 40-hour workweek was built with real and documented intentionality to produce a stable, predictable consuming workforce, and it has done that job for nearly a century with remarkable consistency. It was never built and has never functioned as an optimized vehicle for individual wealth accumulation. That isn't a flaw in the system from the perspective of the system's actual design goals. It's simply not what the system was built to optimize for. Understanding this distinction between what a structure was designed to do and what you might mistakenly assume it should do is the actual unlock here. Not quitting your job tomorrow. Not believing the entire economic system is a conspiracy against you personally. Just clearly seeing the mathematical ceiling that exists, understanding precisely why it exists, and making informed decisions about where to direct the hours and capital that exists outside of it. The people who build genuine wealth inside a 40-hour structured economy are not, for the most part, people who found a loophole or a secret. They are people who understood the ceiling clearly enough to stop expecting employment income alone to break through it, and who directed their additional effort toward income and capital structures that were never bound by the same limitations in war. The first place. Now you understand exactly where that ceiling is and exactly why it's there. What you do next is up to you.